Crypto tax in the UK explained 8 things HMRC expects you to know. Some UK crypto investors may be accidentally getting their HMRC reporting wrong, without even realizing it. Not because they're hiding anything, but because crypto tax in the UK works very differently from what most people assume. For example, you might think tax only applies when you cash out into pounds, but under HMRC rules, you can create a taxable gain without ever touching your bank account. And with new global reporting rules rolling out for certain crypto platforms, the chances of HMRC spotting mistakes are increasing. The good news? Once you understand the rules, there are perfectly legal ways to reduce your crypto tax bill and avoid costly mistakes. So in this video, we're breaking down 8 crucial things every UK crypto investor needs to understand for 2026 and beyond, including what crypto transactions actually trigger tax, which ones don't, how crypto is taxed for individuals and companies, and how smart investors may legally reduce their tax bill. Let's start with the biggest misunderstanding. First, the biggest crypto tax myth in the UK. Many investors believe crypto only becomes taxable when they convert it back into pounds. But that's not how HMRC sees it. Under UK tax rules, crypto is usually treated as a capital asset, similar to shares. This means tax can arise whenever you dispose of a crypto asset, and a disposal happens more often than most people realize. Second, crypto transactions that trigger tax. There are 4 common situations where crypto becomes taxable. Number 1, selling crypto for pounds or another fiat currency. If someone buys Bitcoin for £5,000 and later sells it for £15,000, the £10,000 profit becomes a capital gain. Number 2, swapping one cryptocurrency for another. For example, swapping Ethereum for Solana. HMRC treats that as if you sold Ethereum at market value and then immediately bought Solana, even though no money touched your bank account. This is one of the most common crypto tax traps. Number 3, using crypto to pay for goods or services. Buying something with crypto is also treated as disposing of the asset. If the price increased since you bought it, a taxable gain may arise. Number 4, gifting crypto to someone else. Giving crypto to a friend or family member is normally treated as selling it at market value. But there is one important exception. Transfers between spouses or civil partners are usually tax-free, and that rule becomes very useful for tax planning. Third, crypto transactions that do not trigger tax. Now let's look at situations where tax doesn't normally apply. First, buying crypto with pounds. Purchasing Bitcoin or another cryptocurrency is not taxable. Tax usually arises later when you dispose of the asset. Second, moving crypto between your own wallets. If you transfer crypto between wallets you control, ownership hasn't changed, so HMRC does not treat that as a disposal. Third, simply holding crypto even if the value increases dramatically. There is no tax until you sell, swap, spend or gift the asset, but the moment one of those actions happens, the tax calculation begins. Fourth, how crypto is taxed for individuals. For most UK investors, crypto profits fall under capital gains tax. For the 2026-27 tax year, individuals have a £3,000 annual capital gains allowance, and that's for all taxable asset gains, not just crypto. This means gains up to that amount can normally be realized before tax applies. Anything above the allowance is taxed depending on your income band. The current rates are typically 18% for basic rate taxpayers and 24% for higher rate taxpayers. Another important point is that gains are stacked on top of your income. So a large crypto gain could push part of that gain into a higher tax band. HMRC also allows certain costs to reduce your gain. These can include purchase costs, transaction fees, broker or professional costs linked to the transaction. Crypto also follows 3 share pooling rules. Rule 1, the same day rule. Buy a coin and sell it later that same day. Those trades match first. Buy at £900, sell at £1,100, and the gain is £200. Rule 2, the 30-day rule. Sell a coin and buy it back within 30 days. And HMRC links those trades together, which means the loss you thought you locked in might not count yet. Rule 3. Section 104 pooling. If the first 2 rules doesn't apply, HMRC averages your costs. Buy Bitcoin at £18,000, then again at £26,000. Your average cost becomes £22,000. Sell at £25,000, and the gain is £3,000. These rules can make calculations more complicated than many investors expect, which means your real crypto gain might not be what you think. Fifth, how crypto is taxed inside a limited company. Some investors wonder whether holding crypto through a limited company saves tax, but it isn't always as simple as it sounds. Companies do not receive the £3,000 capital gains allowance. Instead, profits are taxed under corporation tax, which can be 19% or 25% depending on company profits. Then, if profits are extracted as dividends, dividend tax may apply as well. This can effectively create 2 layers of tax. Because of this, holding crypto personally is often simpler for smaller investors. However, companies may make sense in situations such as crypto-related businesses, active trading companies, and situations where profits are reinvested inside the company. The right structure depends heavily on individual circumstances. Sixth, legal ways to reduce crypto tax. Now let's look at some legitimate strategies investors use to reduce crypto tax in the UK. First, use your annual capital gains allowance. Each year you can realise up to £3,000 of gains tax-free. Many investors forget to use this allowance and end up with a much larger taxable gain later. Second, use the spouse's allowance. Transfers between spouses are normally tax-free. This means both people can use their £3,000 allowance, potentially allowing £6,000 of gains to be realised without capital gains tax. Third, claim losses properly. If crypto is sold at a loss, that loss can be carried forward and used against future gains. But the loss must be reported within 4 years of the relevant tax year. Fourth, deduct allowable costs. Transaction fees and certain professional costs can reduce your taxable gain, but only if proper records are kept. Fifth, some investments held inside an ISA can give you exposure to crypto. Most people think crypto and ISA investments never mix, but there is one situation where they can overlap. Some investors gain exposure to crypto through something called a crypto exchange traded note, or ETN. Think of it like this. Instead of buying Bitcoin directly, you buy an investment product that tracks Bitcoin's price. So if Bitcoin rises, the value of that product rises as well. Now here's why this matters. If that investment sits inside an ISA wrapper, the gains inside that ISA are usually free from capital gains tax. Here's a simple example. Imagine someone invests £10,000 into a crypto exchange traded note inside an ISA. A few years later, the value grows to £18,000. Outside an ISA, that gain could potentially be subject to capital gains tax. But inside the ISA wrapper, the gain is normally tax-free. However, there's an important point. This is not the same as owning Bitcoin directly inside an ISA. It's simply exposure to crypto prices through a financial product. And after April 2026, these products are generally held in an innovative finance ISA, rather than a stocks and shares ISA, which is less tax efficient depending on how you hold them. Seventh, why record keeping is essential. Crypto tax calculations can get messy very quickly, especially if you've used multiple exchanges, wallets, or multiple platforms. HMRC expects investors to keep records such as the type of crypto asset, the date of each transaction, the value in pounds at the time, transaction fees, and how many tokens you held before and after a disposal. Without this information, calculating gains later can be extremely difficult. And if HMRC asks questions about your return, you may need to show how your numbers were calculated. Some investors use crypto tax software to track everything automatically. But a simpler option is just keeping a basic spreadsheet. For example, record the date, coin, number of tokens, pounds value, and fees for each trade. Most exchanges also let you download your transaction history, which you can keep as supporting evidence. It might feel boring at the time, but it can save hours of stress when tax season arrives. Eighth, why HMRC is paying more attention to crypto. Crypto transparency is increasing globally. Since the 1st of January 2026, the UK implemented the Crypto Asset Reporting Framework, which requires in-scope crypto platforms to collect and report certain user data. Over time, this allows countries to share crypto transaction information internationally. HMRC has also sent letters to some investors asking them to review their crypto tax reporting, which means ignoring crypto tax is becoming increasingly risky if gains are missed or reported incorrectly. HMRC may charge interest and financial penalties, and in some cases, they can review and assess previous tax years. Final thoughts. Crypto investing can be exciting, but the tax side is often overlooked. If you remember these key principles, understand what triggers tax, keep proper records, use your allowances wisely, and plan ahead, you'll avoid most of the mistakes UK crypto investors make. Important note, this is not a tax or investment advice and may be different for your own personal situation. And if you're unsure about your crypto tax position, consider speaking with a qualified UK tax advisor before submitting your return. Because when it comes to crypto tax, the biggest problems usually start years before investors realize it. If you want clear explanations of UK tax rules, HMRC updates, and smart financial strategies, make sure to subscribe to the channel.